All right, let's dive right in. We're about to put on our detective hats and solve a classic corporate mystery. The case? It's all about how companies account for costs that, well, haven't even happened yet. These phantom expenses that are just lurking in the future. It's a real puzzle of probabilities and possibilities, and our investigation starts right now.
So let's put you in the hot seat. Imagine you're the CFO. You got a call, and bam, you find out your company might get sued. Or maybe you just know that a handful of the products you sold this year are definitely going to come back for warranty repairs. Thing is, there's no bill on your desk, but you can feel this cost looming. So how do you put a number on that? I mean, how do you account for a ghost? That is the exact question we're here to figure out.
Now, to crack a case like this, every good financial detective needs a rulebook. And in our rulebook, there are two absolutely crucial terms you need to know: provisions and contingent liabilities. Trust me, understanding the difference between these two is the key to uncovering a company's hidden financial risks.
Okay, first things first, let's get our definitions straight. What exactly is a liability? Well, think of it this way. You buy a coffee with your credit card. The second you swipe that card, you have a liability. You haven't paid the bill yet, of course, but because of a past event, buying the coffee, you now have a present obligation to pay up. The key here is that the obligation exists right now.
So, if a liability is a pretty clear-cut obligation, then what in the world is a provision? Well, you can think of it as a liability with a big old question mark attached to it. You know you owe the money, but the when and the how much, yeah, those parts are still a little fuzzy. It's like your car breaks down, you have a present obligation to pay the mechanic, but you're not going to know the final bill until all the work is done, right? That uncertainty is exactly what makes it a provision.
All right, so a provision is all about uncertainty. But what's a contingent liability? This is where things get interesting, because we're shifting from uncertainty to pure possibility. You might owe it, or you might not. The whole thing depends on some future event. For instance, let's say you're fighting a parking ticket in court. You don't have an obligation to pay yet. You only will if you lose the case. That possibility of having to pay, that's a contingent liability.
And here's the official, by-the-book definition, which pretty much confirms what we just talked about. It's either a possible obligation, like our court case, or it's a present obligation that's just too iffy to be called a provision. Maybe it's not probable you'll actually have to pay, or maybe you just can't come up with a decent estimate for the cost. It's really just a financial maybe.
So, how on earth does an accountant navigate this confusing world of maybes and probablys? Well, they use a map, a very specific kind of map actually. It's a decision tree that guides them from a potential future cost to a clear, actionable accounting step.
So the whole journey starts with this one critical question. Is there a real, present obligation right now because of something that already happened? Selling a product that has a warranty. That creates a present obligation. But a potential lawsuit? That might not. This is the gateway question. If the answer is no here, you're heading down a totally different path.
Okay, let's say we have a present obligation. The very next checkpoint on our map is all about probability. We have to ask ourselves, is it probable that we'll actually have to shell out some cash? And I don't mean just possible, I mean probable, which in the accounting world basically means more likely than not.
And if the answer is yes, again, we hit our final test. Can we make a reliable, trustworthy estimate of how much this is all going to cost? Now, we don't need the exact number down to the penny, but we do need what the rules call the best estimate. We have to have some reasonable number to work with.
And here it is, the full map. This decision tree puts it all together beautifully. Just follow the yes path all the way down the left side. Is there a present obligation? Yes. Is an outflow probable? Yes. Can you estimate it reliably? Yes. Boom. You've got yourself a provision. But notice how a single no at any point sends you down a completely different road, leading to either just a little note in the reports or sometimes doing nothing at all.
Okay, that's all the theory. But how does this stuff actually play out in the real world? Let's open up a case file and take a look at the annual report for a huge company, Qantas Airways, to see this decision tree in action.
Okay, now don't worry about reading every single word on this slide. This is a real page straight from the Qantas Airways annual report. Specifically, it's the section on contingent liabilities. Buried right here in all this text are the company's financial maybes. We're talking about things like legal disputes, guarantees, and all sorts of other potential costs.
And this quote right here, this is the smoking gun. Just look at the language Qantas is using to explain why these items are contingent liabilities and not provisions.
They say it's because it is not probable that a future outflow will be required, or the amount is not capable of reliable measurement. Does that sound familiar? It should. They are literally using the exact wording from our decision tree. They're telling us, word for word, which tests these potential costs failed.
So we've followed the clues, we've looked at the evidence, and we've cracked the case. But what's the real takeaway here? I mean, why should you even care about this nerdy distinction between a provision and a contingent liability?
Well, first off, it's so important to know what a provision isn't. It is not a corporate piggy bank. It's not some slush fund for vague future plans like, say, routine maintenance. A provision has to be tied to a real, existing obligation from something that already happened. Think of it as a known debt, but with fuzzy details, not a savings account for a rainy day.
And this, right here, is probably the single most important point of this entire explainer. A provision gets recorded on the balance sheet. It directly affects a company's reported numbers, their liabilities, their equity. A contingent liability, though, it only gets disclosed in the footnotes, the fine print or the financial statements. One changes the headline numbers, the other is a warning sign hidden in the text.
So the lesson here is pretty clear. If you only read the big, splashy numbers on a financial report, you are missing half the story. To really understand a company's true risk profile, to find the clues about potential lawsuits, big guarantees, and other threats lurking in the shadows, you have to read the notes. That's where the real detective work begins.
And just like that, our investigation is closed. You now know the code. You know the difference between a liability that's on the books and a risk that's hiding out in the fine print. So the next time you pick up a company's annual report, I've got one question for you. What story are its notes just waiting to tell?